Major risks still loom on the horizon for investors. What should we do now to navigate this tumultuous and very volatile market? Looking ahead for us is Ted Oakley. He is a founder of Oxbow Advisors, and he is back with us to dissect market action and give us his outlook for the remainder of the year. Ted, welcome back to Kitco.
Thanks, David.
You were on a show a few months ago, and back then you had told me that the greatest risk that investors are facing today is the overvaluation of the stock markets. Now, stock markets haven't majorly corrected since we last spoke a few months ago. I'm presuming this might still be a risk for you. So the question I have for you today, Todd, starting off our discussion is, should investors sell off their holdings or at least take some profits today, especially on the eve of what many anticipate is a rate hike in March, the first that the Fed is supposed to do out of many years?
Well, David, I would say yes, if you have no liquidity, because you can't do much. You know, the problem about sell-offs is that if you get into a situation where things are really attractive and you have some real opportunity, if you don't have any liquidity, you can't take advantage of it. All you do is move, from one box to the other. And so one of the things we mentioned back then, which is still the case today, if you look at it, we haven't had any market movement since I last talked to you to speak up. Matter of fact, the NASDAQ and the Russell are probably lower than they were 2 months ago. But the thing about it is it probably doesn't show up until the second quarter. I mean, the Fed now is locked in. They have to raise in March after today's numbers, and probably February too, if you just look at what's happening. But you have to keep this in mind. Again, that's all looking backwards. You don't have any of the stimulus that we had last year. So if you look at the consumer, they're going to be under pressure. And I just ran the numbers today. If you take a $400,000 mortgage today, it'll be up 20% from where it was a year ago on the payment now.
Wow.
And so things will change on that. And so if you think the payment goes up 20% and the home goes up 20%, all of a sudden we're into territory where you lay that out and that blocks that down a bit. Then you've got a situation where the Fed will probably raise into a slowing economy, which they always do. They're always late. And you can't really believe them because they're always late to everything. And so what happens is they're going to raise into a slowing economy. Then all of a sudden, oil takes it, oil's a tax on smaller people, on the 50 or 60% that have to go week to week. It's a tax. And so we see us slowing down, not necessarily going away, but we see inflation really coming off after the first quarter, second, third quarter. We see that happening. And we think it'll impact the markets. And
Wait, what do you mean by coming off?
Yeah.
Sorry, what do you mean by coming off?
I think inflation we're at 7.5, maybe you stay at 7.5. Yeah, maybe you could go all the way back to 1 or 2. But certainly I would think you would come back to 3 before it's all over with. But just the economy just couldn't stand it. And we've already had rate hikes globally. We've had 40 rate hikes in developed and emerging market countries in the last 8 months, 40. And then in addition to that, here we are, people talking about raising 5 times this year. We don't think they've got a chance at that. 1 or 2, maybe. But even then, if you stop and think about it, it changes the whole look of everything.
Okay, so hold on. A couple of things here. You said you dropped a couple of bombshells in the last 2 minutes. I need to come back to some of these points. Inflation is coming back down to, you didn't say 1 or 2%. You said it could, but it's coming back down anyway. When is it coming down? You said second quarter this year?
Well,
because we just had the highest reading in 40 years, Ted.
Exactly, and that's the whole point. What happens is, if you're into a slow, these things happen at the tops. They don't happen at the bottoms. And I don't think we're in a position right now where people are keeping in mind that one of the things that happened last year is people had the money to pay up for things. They could pay up for inflationary things. This year, it's a different story. There's no free money coming from either source, fiscal or monetary. They're in a situation where they spent a lot of what was there. And so the market itself locks it down. So if you have $90 oil, real estate up 20, 30, 40%, depending on how you want to do the payment, you look at all these things put together and what they're having to pay now for groceries, and you look at it and all of a sudden it slows itself down. That's our point. As you get past this major spot where we are right now, which is probably, I'm guessing February comes in just like January. But as you get into April, May, and June, and then further, that should roll down. That start down.
So you think that this year isn't necessarily the year for inflation hedging then?
I would say not. If you look today, for example, David, if you just look at the difference between the 10-year yield and the 30-year yield in U.S. Treasury today, it's 1/4 of 1 point a quarter. You're so close to being completely flat that anything else they do, which is probably March, will invert that curve, and here you go. That gets it started, and I think that's where we'll head from there.
Okay, so you think the Fed's going to be successful in tapering inflation, or do you think inflation is going to come down naturally by itself anyway, regardless of Fed intervention?
Well, the problem is the Fed caused it. So everybody wants to look back and say, well, they're the great, but they're going to come to our rescue. Well, they're the ones that caused it at the beginning. And secondly, they're not going to have anything to do with it being over with, because the market will take care of itself. And then, they can stick their chest out if they want to. But what really will happen is the market will take, it's one of the good things about me is I grew up in all three socioeconomic levels. I know what goes on with people that go week to week. I know what's in their head. And so when you have those kind of cost increases, you quit buying things, you quit going places. And that's what will happen this year, we think.
Okay. And the Biden administration, what are they going to do about this?
Well, they want inflation down, and so they'll get it, I think, in terms of what they're looking for. The problem I think you'll get into here is that the Fed can't pivot at 10% down on the NASDAQ, for example, or the Russell. We think you'll have to go deep because, see, they're locked in a box. They're saying, well, we're going to fight inflation, and they're right. They're on the precipice of when you go the other way, but it's still high, so they can't. You can start to have breaks in the market in the second quarter, and they can't do anything until you get down to maybe 25 or 30. They could do something then, because they'll say, well, it's enough. We'll make a change. And then all of a sudden the administration will be worried about that side of things. So that's the box they're in right now, and that's the way we see it.
Okay, Ted, now you're an investor, and you've probably got a lot of questions on your mind for the government. Suppose you're having lunch with Jerome Powell today. Right after the latest inflation numbers came out, the highest it's been in 40 years, 7.5% headline CPI. What would you ask him?
Well, my question to him, David, would be, why wait so long? I mean, one of the problems the Federal Reserve always has is they're late for everything. And he knows this. He's been around long enough to know this, because he's been on that board for a long time. And yet we wait and wait and wait. And I think all of these Fed presidents have gotten this idea that, hey, I've got this under control, don't worry about it. Well, they really never have it under control, because they're always late to the game on everything they do. They juice it too much. That's what they did last year. My question to him is, why would you do that for? Were you just under political pressure? Or, I mean, you had enough stimulus out there without having to just keep on buying paper all year long. I mean, $120 billion a month. When you had mortgages already at all-time lows, you're buying $40 billion mortgage MBAs a month. I'm like, why would you be doing that? And that would be my question to him is, what are you thinking about?
Well, the problem is, Ted, the Fed doesn't believe that they caused inflation. And remember back in February last year, Jerome Powell had said in a press conference that inflation is not a monetary phenomenon. We need to unlearn monetary theory, were his words. And of course, they've been pretty vocal about the fact that supply chain issues were the main culprit of inflation, and for the longest time they thought inflation was transitory. So to your point about, why have you kept the heat on for so long? Well, if I were Powell having lunch with you, I would just say, well, simply because I didn't think it would have mattered, right?
Well, I think that's right, David. But obviously, again, they missed it on transitory. Now, see, we owned a lot of energy starting 18 months back, because we really thought that was going to happen. It was not going to be transitory. We thought the major parts of that inflation, which are energy, real estate, sort of thing, all that sort of, they were going to go higher, which they did go higher. And, we could see it happening, but they were hard-headed to say, hey, we think it's going to be transitory, when everybody else was looking around and saying, well, it doesn't look like it. And so now they're stuck, and so they have to come in and be harder. But I think they're late. I think it'll backfire on them before it's all over with. We'll see, but that's where we are.
I want to take a look at the dollar now. The DXY today, right when the data came out for inflation, shot up, and then it came right back down. I don't know if you noticed that, but that was a pretty dramatic move, upwards and then downwards. We're speaking right now past noon Eastern time, and the DXY is below. It opened, well, not opened, but below its level 24 hours ago. What happened there? Why the sudden change in the dollar?
Well, a lot of investors, and I think foreign investors too, probably have looked at that and thought, Fed's raising rates, it's going to settle things down. A lot of times the dollar goes up when they do that. I wouldn't be surprised that the shorts didn't cover on that, and then it came right back to them, because somewhere along the line, people have to think, they raise rates. It's okay for, maybe settling things down, but now we're going to look past it and what happens to the actual economy. And then you have the selling. And so I don't see the dollar running away here for sure. If anything, I think eventually it gets weaker, but maybe not right here.
It's going to get weaker this year, given several rate hikes expected.
I'd be surprised, David, we get that's our point, is that if we really sort of feel like it would probably only be one time, maybe two, because by that time, if you have the markets really breaking down, I'm talking about the stock markets, they're going to get, they get real antsy when the markets break down. And so they've tied everything to finance or the stock market. So that's where they are right now. But I think, from an investor standpoint, if you don't have any liquidity right now, you need to this is the first time in your investing history, so to speak, since 2018 that they're trying this experiment. And for you to be sitting there with no liquidity at all is a big bet, in our opinion, over the next 6 to 9 months.
Okay. Well, given your outlook on the dollar, then, how does that impact gold? Inflation and the dollar, let's put those two variables together and give us your gold outlook for the year.
Well, we like gold, as I've mentioned before, and two of our strategies, we have the bullion, but we also own some of the miners. And the miners will correct too. You have to keep it in mind. We have a mix, because while gold may not go down as much when a market sells down, the miners will. And you have to keep that in mind, even though they're as cheap as they've been in 25 years. So we have the bullion and the miners. So what we expect is not so much inflation or deflation, but we think it's the fear factor. When people get nervous about things and they're unsure about things, gold tends to pick up. And so we think gold, it's held its own this year. It's still, I know people are they're wondering, hey, are we ever going to get past 1800, 1820? We will, I think. And when we do, I think you're going to have a straight shot for a pretty, fairly good number. But I think it's wise to hold some in here.
Well, you said that we're on the heels of an economic slowdown. You said that earlier, and you mentioned mortgage rates. By the way, mortgage rates are at the highest level since 2020. So many would speculate and agree with you that this is going to cause a slowdown in at least housing demand. But let's talk about whether or not this fear that you were just talking about is actually going to translate into market fear. In other words, do you think the stock markets are going to react adversely to a potential economic slowdown? And if it does, what's that going to do to gold?
Well, I think it does. I think it will. The market will react to that, because you'll all of a sudden, you mentioned the mortgage rate, so 398 this morning on a 30-year mortgage. Let's call it 4%. Well, a year ago, it was 280. I mean, you're talking about a big move here. And then if you just tack the price on top of that. So that's one area. The second area is when it gets into I think what happens in the marketplace is that when the selling sort of begets selling, and every time you get one of these 10% sell-offs like we just had, and all of a sudden it comes back a bit, maybe not all the way, they keep on this idea of buying the dip. Well, there's a spot in here, and we think it's this year, by the way, that the buy the dip will not work.
Buy the dip will not work.
No, not in the short run. In the long run, perhaps. But we just think to get to a normalization of where you want to put more cash to work, you have to go lower than that 10%. I don't know what it is. Maybe it's 20, 30. I don't know. But it's lower than that. And that's where we are.
Well, one of the things that might cause a massive sell-off is a correction in the housing market. I don't know if there's going to be a correction in the housing market just because mortgage rates are ticking up. Now, I'm based in Canada. I don't know about Texas, where you live, or across the U.S., how many people have mortgages on a variable or a fixed? Because if everybody's still got a fixed for a couple of years, I don't think it's going to matter right away, would it? Unless you're talking about new homeowners, and that might affect demand. But then where else are they going to go?
Well, that's true. If you already have an existing, if you have an existing mortgage, you're going to be okay, because probably if you set it up originally like that on the variable, you were all right for the first 3 or 4 or 5 years. But here's the thing: if you look at existing home sales and new home sales, they will be based on someone buying that house and then putting a mortgage on it. So you're going to find that we already see mortgage apps they've gone way down the last, I'm going to say way down, but they've turned down the last 2 and 3 months, because that's really what's happening in the marketplace. And I know everybody in the real estate business thinks, oh, it can't, it's never going to stop. Well, I've seen it stop before, and it stops really quickly when it stops. And I suspect that that 4% rate on that 30-year mortgage is a breaking point. Now, maybe it's not, but I think it will be. And
4%.
I think
Okay. Breaking of what?
If you look at the 30-year mortgage, for example, at 4, and you say, okay, well, I've basically gone up. If you just look at the rate, I'm using the rates now from a year ago, and I could get a mortgage at 280 or 282, and I'm at 4, let's say today. That's what impacts the person. It all gets back to the payment. If you get back, look at old business people that sell cars or houses or anything else. They'll all come back and tell you, hey, Ted, it's all in the payment.
So
it's all in the payment. And that's where we are. The payment's going up.
Payment's going to go up. Discretionary spending, I guess, is going to go down as a result. And so that's going to have a feedback loop on aggregate demand in the economy.
Has to have almost, David, because if you look at last year, for example, and you still had the effects of PPP and the business. Then you had all this other money that came out, the stay at home, everything, child credits. The only thing they were able to keep is to keep a moratorium on student loan payments through May, but that goes away this May too. Yeah. So all of those things go away. It doesn't look like we're going to bring anything to support them either. So that's where we are.
A lot of people are advocating for the government to cancel student debts. They may as well cancel mortgages too while you're at it. Wouldn't that be nice? Ted, final words of advice for investors. I know we've covered a lot of ground. You've given your outlook of the economy. Doesn't look great. Mortgages are a tipping point. Let's put this all together. Investment advice for somebody who may have already been invested or is looking to get into the markets right now.
Well, from our vantage point, don't be fearful of market declines. If you have liquidity, it creates an opportunity for you. It's not something for you to say, hey, I'm afraid of it or something like that. But where you'll make your most money, I know for us, our most money has always been made in poor markets like 87 and 2000 and 03 and 09. Those are periods where, I said 2000 was 03 and 09. Yeah. Those are periods where we had liquidity, so we could really you could really make a difference. And my advice to investors were try to have a little balance right here and don't buy into what's happened in the last 10 years, because we now have a Federal Reserve that is not helping you out right now. So you need to keep that in mind over the next 6 to 9 months.
All right. Ted, I always enjoy our conversations. Very insightful, very thorough analysis as always. Thank you for coming back onto Kitco. I'll speak with you next time.
Thanks, David.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.